Welcome to this explainer. Look, let's jump straight in. Today, we're acting as a specialized analytical engine to totally deconstruct the mechanics of employee tax withholding. You know, for most folks, filling out their withholding documents, it feels like the ultimate set it and forget it task. You hand it to HR on day one, and poof, never think about it again. We just assume the system's got it perfectly handled. But based on anonymous expert reports and verified analytical data, we're going to pull back the curtain. We're breaking down how this financial mechanism actually operates beneath the surface. And honestly, treating the system like some infallible autopilot isn't just a tiny oversight. It actively conceals massive compounding financial liabilities that can seriously disrupt your fiscal baseline. We've got to start by completely shattering a really common and frankly dangerous myth. The reality here is that tax deductions, they are absolutely not a passive safety net that just magically runs in the background of your payroll processing. Expert analysis reveals withholding is actually a highly active, dynamic mechanism. It literally demands proactive, precise calibration on your part to maintain financial predictability. When you just leave it on autopilot without constantly analyzing your evolving financial inputs, stuff like life changes, a side gig, or a spouse's earnings, you're essentially flying blind. You're opening the door to hidden liabilities that quietly grow in the background, and the kicker? You won't even see them coming until it's time to file your return. So to actually get a grip on this, we have to examine the core mechanism itself, the Employee Withholding Certificate. Yep, we're talking about Form W-4. This is the formal document that dictates the exact proportion of income your employer is legally required to pull for tax purposes every single pay period. Now, I want you to think of this certificate as a foundational algorithm. It's not just some bureaucratic piece of paper. It provides the exact mathematical inputs that your company's payroll software uses to calculate your annualized income and dynamically apply tax brackets. It's basically the master control switch. It dictates the entire flow of tax liabilities, right from your paycheck into the revenue system. Getting the precise settings right on this one document, absolutely crucial for your year-round financial health. Which brings us to a massive question to guide our analysis. Does precision in those initial withholding estimations truly impact your annual financial stability? Well, the analytical data confirms that yes. These initial estimations establish a critical baseline of compliance. It's kind of like setting the trajectory for a rocket launch. If your calculations are off by even a fraction of a degree at the launch pad, well, that tiny error cascades, right? It compounds. Over the course of, say, 26 typical biweekly pay cycles in a fiscal year, that seemingly minor miscalculation pushes your tax trajectory further and further off course. And ultimately, it culminates in thousands of dollars in totally unexpected discrepancies. The divide between actually getting this right and just guessing is profound. When we contrast calculated estimations against uncalculated defaults, the cause and effect relationship is, well, it's undeniable. On one hand, accurate utilization of estimator tools gives you estimated withholding. This locks in a trajectory yielding highly predictable outcomes, literally eliminating year-end financial panic. On the flip side, relying on uncalculated withholding, where you're just checking boxes without running the actual numbers, essentially subjects your hard-earned income to arbitrary deductions. It fundamentally unmoors your tax liability from your actual financial reality, exposing you to severe penalty risks. Actively calculating your baseline is the only way to proactively mitigate those nasty end-of-year shocks. And doing this right creates what experts identify as a highly effective efficiency loop. It's this whole ecosystem of reciprocal benefits. Think about it. When an employee takes the proactive step to use estimation tools and accurately calculate their withholding, it triggers a wildly positive chain reaction. That single action directly reduces administrative friction for the employer. Instead of HR and payroll departments pulling their hair out fielding questions, fixing cascading errors, or processing retroactive adjustments, the entire system just hums along. It leads to incredibly streamlined payroll adjustments. It just proves that active calibration by the individual eliminates immense friction for the entire administrative framework. Anonymous expert reports actually encapsulate this macro-level impact perfectly. They state that More accurate estimates reduce surprises at tax time and save significant time on payroll adjustments. So the big takeaway here is that optimizing the withholding process down at the micro, individual level doesn't just protect you from a stressful, unexpected bill in April. It actively scales up. It creates immense operational efficiency at the organizational level. We're talking about saving companies countless hours of administrative rework and manual corrections that inevitably happen when employees are shocked by their tax withholdings. Okay, now that we've got the baseline mechanics down, we really need to expose a critical, highly non-obvious exception in this system. We have to challenge an implicit assumption that, honestly, almost everyone in the workforce makes, and that is, are all employer-provided benefits automatically subjected to tax withholding? It sounds like a beautifully simple question, right? But getting the answer wrong carries massive hidden financial implications. Let's dig into exactly why this specific oversight is so incredibly dangerous for your baseline compliance. The core danger here lies entirely in a widespread psychological blind spot. Taxpayers just naturally assume that all employer-provided financial benefits are automatically taxed right there at the payroll level. And logically, it makes perfect sense. If 99% of your standard paycheck handles taxes seamlessly, you're naturally going to assume that any extra financial assistance provided by the company is getting the exact same treatment. This implicit assumption totally lulls the taxpayer into a false sense of security. But as expert analysis shows, treating all income as perfectly equal within the automated payroll system is a fundamentally flawed premise. When you look at the verified data, it reveals a stark and highly consequential gap between standard compensation and fringe benefits. Standard wages, your regular salary or hourly pay, are absolutely subject to automatic withholding adjustments. The algorithm knows exactly what to do with them. However, specific qualified assistance expenses, say specialized adoption assistance programs or certain educational benefits, are often entirely exempt from automatic withholding requirements. So what happens? The money hits your account, the benefit is fully received and utilized, but the corresponding tax liability? It hasn't been touched at all by the automated system. This precise discrepancy creates what experts accurately identify as the withholding gap. This is the hidden tax liability that's created when non-withheld employer benefits cannot be excluded from your overall taxable income. Imagine receiving, say, $5,000 in specialized employer assistance. It's awesome, but it accrues silently in the background of your finances. If, for whatever reason, that specific benefit ultimately fails to qualify for a complete income exclusion when you finally file your returns at year end, this invisible gap suddenly transforms into a very real, very demanding, and entirely unplanned financial shortfall. And the direct consequence of failing to recognize this gap? It isn't just that you owe the missing taxes. Oh no, it's worse. You also trigger the underpayment penalty. This is a severe financial consequence enacted when your accumulated tax liabilities significantly exceed the withheld and estimated payments you've actually made during the fiscal year. It's a harsh, cascading financial mechanism. We're not just talking about a flat fee here. It's a calculated penalty based on the shortfall itself. When unadjusted withholding certificates fail to account for non-withheld income, this penalty serves as a highly punitive wake-up call for the passive taxpayer. So we know the threat is invisible, and we know the resulting penalty is surprisingly severe. The immediate question then becomes, how do we neutralize this hidden liability before it ever has the chance to trigger? Like, what strategic mechanisms are actually available to the individual taxpayer to proactively close this gap, regain control of their algorithm, and ensure absolute compliance throughout the entire year? While the expert analysis prescribes a strict, highly strategic 3-step mitigation plan to completely neutralize the threat. Step 1, you must proactively identify any non-excluded benefit income you're receiving that is currently bypassing the automatic withholding system. Step 2, you submit a newly adjusted withholding certificate to your employer. This is the exact mechanism you use to recalibrate the algorithm to account for that extra money.
And step 3, as an alternative or even in addition, you can calculate and execute manual estimated tax payments. Let me be clear, these aren't just polite suggestions. They are the concrete mechanical actions absolutely required to protect your baseline.
When executing this strategy, taxpayers essentially have to choose their specific mechanism of correction, and the right choice depends entirely on your personal financial complexity. You could utilize an adjusted withholding certificate, which fundamentally upgrades your payroll system to provide seamless, automated per-paycheck deductions. Alternatively, you can opt for estimated tax payments. But remember, those require the highly manual execution of periodic lump sum payments sent directly to the revenue system throughout the year. So one path entirely automates your compliance through your employer, while the other requires constant manual maintenance and really strict cash flow management on your end.
The analytical report distills this strategy into one highly actionable, definitive piece of advice. It states, if payments cannot be excluded from income, it is wise to submit an adjusted withholding certificate to avoid penalties for underpayment. So the crucial takeaway here is that proactively recalibrating that core withholding certificate is widely considered the absolute most efficient, foolproof method available. It brilliantly leverages the existing automated payroll infrastructure to flawlessly bridge the withholding gap, which completely bypasses the risk of human error and those punitive financial measures we talked about.
Synthesizing all these expert findings leaves us with an incredibly clear thesis on active versus passive financial management. First, withholding is never, ever passive. It requires your active calibration. Second, utilizing estimator tools creates a systemic efficiency loop that benefits literally everyone, both you and your employer. Third, you absolutely must dismantle the implicit assumption that all financial benefits are automatically taxed, because many entirely skip the automated system. And finally, relying on outdated, unadjusted certificates when you're receiving these specific benefits virtually guarantees severe compounding financial penalties. We're going to leave you with this provocative final thought to help evaluate your own systemic compliance. Ask yourself right now, is your current withholding certificate an actively calibrated shield protecting your financial baseline, or is it silently accumulating a hidden liability just waiting to trigger a massive penalty next spring? Take the time to apply this analytical framework to your own situation. Thanks for joining me on this explainer. I really hope this deep dive empowers you to take absolute control of your financial mechanics.